Scene script. Have you ever wondered what makes an investor successful in the volatile world of finance? In this vast ocean of financial markets, where waves of prices rise and fall with an unpredictable rhythm, navigating your way towards success can seem like a daunting task. But what if there was a compass, a guide that could help you steer clear of the reefs of risk and sail towards the islands of investment prosperity? That's where The Intelligent Investor comes into the picture. Authored by Benjamin Graham, this book is often referred to as the Bible of investing. Its principles have stood the test of time, weathering economic storms and financial turbulence, and continue to guide investors towards making sound financial decisions. Benjamin Graham was not just an author, he was a pioneer, a guiding light in the world of finance. His teachings have shaped the investment strategies of countless successful investors, and his influence echoes in the corridors of Wall Street and beyond. Among his many disciples, one name stands out, a name synonymous with investment success: Warren Buffett. Buffett, one of the most successful investors in the world, was a student of Benjamin Graham. He has often attributed his success to the principles he learned from The Intelligent Investor. This is a testament to the enduring wisdom of Benjamin Graham and the relevance of his teachings in today's financial landscape. The Intelligent Investor isn't just a book, it's a roadmap to investment success. It doesn't promise a quick route to riches, but rather a disciplined approach to navigating the complex world of investing. It's about understanding risk, recognizing value, and making informed decisions. It's about becoming not just an investor, but an intelligent investor. So, are you ready to embark on this journey of financial wisdom? Are you prepared to learn the principles that have guided some of the most successful investors in history? Let's delve into the wisdom of Benjamin Graham and see what it takes to become an intelligent investor. What is the difference between investing and speculation? This question sets the stage for our exploration into the first chapter of Benjamin Graham's seminal work, The Intelligent Investor. At the heart of the matter, Graham draws a clear line between investing and speculation. He defines an investment as a commitment that ensures the safety of the principal and offers a satisfactory return. It's a methodical, calculated approach, grounded in research, analysis, and a long-term perspective. On the other hand, speculation is akin to a gamble. It's driven by the allure of quick profits, often based on trends or hot tips, rather than solid financial analysis. While it might seem thrilling, it carries a high risk and doesn't guarantee the preservation of your principal. Graham's wisdom thus encourages us to be discerning, to make informed decisions, and to focus on sustainable growth. Remember, speculation can be exciting, but it's investing that builds lasting wealth. How do you protect your investment from the invisible enemy, inflation? Benjamin Graham, the father of value investing, offers some sage advice on this issue in Chapter 2 of his masterpiece, The Intelligent Investor. Graham advises that the best defense against inflation is to invest in companies with tangible assets and strong earnings power. Let's break it down. Tangible assets are things like buildings, equipment, and land. These are real physical assets that hold their value even when the dollar's value declines. On the other hand, strong earnings power refers to a company's ability to generate high profits, year after year. Companies with this quality can often increase their prices to keep up with inflation, ensuring their profits and your returns stay robust. So, the key takeaway here is to focus on companies with strong fundamentals and real assets. Remember, inflation might be a daunting foe, but with the right strategy, you can shield your investments from its effects. Inflation may be inevitable, but it doesn't have to erode your investment. What can history teach us about the stock market? Delving into the annals of the past, Benjamin Graham provides an insightful analysis of a century's worth of stock market history. His observations serve as a compass for investors, guiding them through the labyrinth of financial uncertainty. Graham's analysis of the stock market history reveals patterns and trends that have persisted over time. He notes that while the stock market has had its share of highs and lows, it has always trended upward over the long term. Therefore, investors who have remained patient and resilient during periods of market volatility have often reaped substantial rewards. One of the key takeaways from Graham's historical analysis is the concept of Mr. Market. This metaphorical character represents the day-to-day fluctuations in stock prices. Mr. Market can be erratic and emotional, offering to buy or sell shares at prices that may not accurately reflect their intrinsic value. Graham warns investors not to be swayed by Mr. Market's mercurial moods. Instead, he urges investors to focus on the fundamental value of a company. If the price offered by Mr. Market is below the intrinsic value of the shares, it could be a great buying opportunity. Conversely, if Mr. Market's price is above the intrinsic value, it might be a good time to sell. The wisdom gleaned from a century of stock market history underscores the importance of maintaining a disciplined approach to investing. Rather than trying to time the market or chasing quick profits, Graham advocates for a strategy based on careful analysis and a long-term perspective. In essence, the lessons from history serve as a reminder that investing is a marathon, not a sprint. It is a journey filled with ups and downs, twists and turns, but with a steady hand on the wheel and eyes focused on the horizon, the rewards can be significant. History doesn't repeat itself, but it often rhymes. Keep that in mind when you invest. Are you ready to learn the principles of intelligent investing? As we delve into the heart of Benjamin Graham's masterpiece, The Intelligent Investor, we encounter principles that have stood the test of time, guiding countless investors towards financial success. These principles, which span from chapter 4 to 20, are not just strategies or techniques, but they are more akin to a philosophy, a mindset, a way of life that every intelligent investor should embrace. Let's start with a principle that Graham strongly emphasizes: the margin of safety. You may ask, what does a margin of safety mean in the context of investing? Well, in simple terms, it's the difference between the intrinsic value of a stock and its market price. Graham advises investors to always seek a substantial margin of safety. This means buying a stock for less than it's worth, thus providing a cushion against potential losses. It's like buying a dollar for 60 cents. It's a principle that guards against the uncertainties and the unpredictable nature of the stock market. Next, we come to the principle of diversification. Graham likens the process of investing to a game of roulette. You wouldn't put all your chips on one number, would you? Similarly, in investing, it's wise not to put all your eggs in one basket. Diversification, spreading your investments across different sectors, industries, and types of securities, reduces risk and increases the chances of overall success. It's a principle that acknowledges that no one can predict the future with absolute certainty. Graham introduces us to two types of investors: the defensive and the enterprising. The defensive investor is one who aims for safety and freedom from bother. They prefer a more passive approach, investing in large, prominent, and conservatively financed corporations that have a record of continuous dividend payments. The enterprising investor, on the other hand, is willing to devote time and energy to select securities that are both sound and more attractive than the average. Understanding which type of investor you are can guide your investment decisions and strategies. Speaking of dividends, Graham places great importance on them. Dividends, the portion of a company's earnings paid out to shareholders, are a tangible return on investment. They are a testament to a company's profitability and often a sign of its financial health. Graham encourages investors to look for companies with a consistent record of paying dividends. Such companies are likely to be stable and reliable, making them ideal for long-term investment. And what about bonds? Graham's advice on bonds is twofold. First, bonds can act as a stabilizer in your investment portfolio, providing regular income and preserving capital. Second, just like with stocks, when investing in bonds, one should seek a margin of safety. This means investing in bonds that offer a yield sufficient to protect against the eroding effects of inflation. These principles of intelligent investing are not about making a quick buck. They are about understanding the nature of the market, acknowledging its unpredictability, and making informed, rational decisions. They are about patience, discipline, and long-term perspective. Graham's principles are not about chasing the next hot stock or trying to time the market. They are about investing with knowledge, with understanding, and with a healthy dose of humility. They are about recognizing that the market is a complex, dynamic entity, not a machine that can be easily manipulated or predicted. As Graham himself said, the individual investor should act consistently as an investor and not as a speculator. This means focusing on the intrinsic value of a company, rather than getting swept up in market trends or hype. It means investing in companies you believe in, based on solid research and analysis, rather than following the crowd. It means being patient, being disciplined, and being willing to learn. So, as we journey through the world of intelligent investing, let's remember these principles. Let's remember the importance of a margin of safety, the wisdom of diversification, the distinction between defensive and enterprising investors, the role of dividends, and the place of bonds in an investment portfolio. Graham's principles aren't a get-rich-quick scheme, but they provide a solid foundation for long-term investing. They are a guide, a roadmap, a compass to navigate the unpredictable and often turbulent waters of the stock market. They are the principles of intelligent investing. So, what does it take to become an intelligent investor, you may ask? Well, we've journeyed through Benjamin Graham's timeless wisdom in The Intelligent Investor, and now let's recap the key points and see how they all come together. Firstly, we've learned the crucial difference between investing and speculation. Investing is not about making quick bucks. It's a long-term commitment to understanding and believing in the value of a company. Speculation, on the other hand, is akin to gambling, based on the whims of the market. Remember, as intelligent investors, we're in it for the long haul. Secondly, we've delved into the relationship between the investor and inflation. Inflation is an inevitable part of the economy, but an intelligent investor knows how to navigate these choppy waters. By focusing on companies that have a history of outpacing inflation, we can ensure our investments grow in real terms. Next, we've traveled through a century of stock market history. Peaks and troughs, booms and busts, they're all part of the journey. But here's the key takeaway. Over the long term, the market has always trended upwards. So keep your eye on the horizon, not the small waves that momentarily disturb the surface. Then we've explored the principles of intelligent investing. From understanding the company's fundamentals to purchasing stocks when they're undervalued, these principles form the bedrock of our investment strategy. They guide us in making informed and rational decisions, immune to the market's daily fluctuations. So, becoming an intelligent investor is not about possessing a secret formula. It's about patience, discipline, and knowledge. It's about understanding the market, the companies, and most importantly, yourself. It's about making decisions not out of fear or greed, but out of careful analysis and sound judgment. Remember, investing isn't about beating others at their game. It's about controlling yourself at your own game. So, equip yourself with the right knowledge, hone your patience and discipline, and embark on your journey to intelligent investing.